Hi guys, I'm going to do another quick ETF video. This one is going to be on a healthcare ETF. I'm going to go over, so the healthcare is one of the sectors that are considered defensive stocks or defensive ETFs. So in defensive sector, I guess you could say includes healthcare, consumer staples, and utilities. So the one I'm going to do today is in healthcare. So let's take a look here. The ticker is going to be XLV. Okay, so it's a healthcare ETF. The expense ratio is, I believe it's 0.09 of 1%. So still pretty cheap as far as expense ratio. It is a little bit more than, say, VTI, which is, probably the cheapest ETF there is, but it's still cheaper than, even a cheap mutual fund expense ratio. So I don't know, cheap mutual fund I would consider anywhere from 0.3, 0.3 to 0.6, I think would be a pretty cheap expense ratio for a mutual fund. Some mutual funds actually have, even a higher expense ratio, 1 to 2%. Some of them have a front load where you pay that expense ratio up front before they subtract the money before you can actually buy into the mutual fund. So I think ETFs or exchange traded funds in general tend to be a lot cheaper as far as expense ratio. So 0.09 is still pretty cheap, a little bit more than say VTI or VEA, but still something I would buy, and I actually do own XLV. Again, this is not financial advice. Do your own research. Another thing I forgot to mention on some of the other videos is that I'll eventually list the approximate 10-year return for XLV as well. But for any, whether it's ETF or even stock, past returns are no guarantee of future performance. So just keeping that in mind. It's just, a probably educated guess. Okay. So back to dividend. The dividend for XLV, it's not super high. I believe it's less than 2%. I believe it's 1.6%, I believe. So not super high, but not bad. And then 10-year return for XLV, I believe is about 11%. So that's 11% annual return on average over a 10-year period. But again, just because it did 11% the past 10 years is not a guarantee that I'll do, exactly the same in the next 10 years. If nuclear war happened, then, probably going to return zero. So you never know. But approximate return on average is about 11% per year over 10 years. Index. So the index is obviously going to be healthcare. And It is, I believe, about 97% domestic, or it's basically U.S. companies. So it's healthcare, and it's going to be domestic stocks. Holdings. Okay, so holdings is going to be a little bit different than the previous ETFs I went over. So much different than, say, VTI, which has 4,000 holdings. Even different than an S&P fund, S&P 500 fund, which is 500 stocks. So, S&P ETF or a total U.S. stock market fund with 4,000 holdings, all those are super diversified. XLV in comparison is not super diversified. So number of holdings is going to be about, I believe, is 62. So 62 different healthcare companies. So what does that mean? Well, so if you ask somebody that trades single stocks or individual stocks, you ask them, well, what do they consider diversified if they're just buying single stocks? Everybody's probably going to have a different answer, but from what I've seen and what I've read, people I've listened to, they're probably going to say between 20 to 30 stocks is pretty well diversified. So obviously this has over 20 to 30 stocks, but the thing you have to keep in mind, all of these stocks are in the same sector. So there is some sector risk if you buy this. Sector meaning all these 62 stocks will be in healthcare. So if healthcare crashes, all these stocks are probably going to crash at the same time. Whereas, if you hold a VTI with 4,000 different stocks, obviously all 4,000 stocks won't crash during a market crash. Maybe the majority of them will, but definitely not 100% of them, which may happen, if healthcare is down and there's only 62 stocks here. So kind of diversified in that there's many stocks, many companies in the XLV, but they're all going to be, they're all going to be healthcare stocks. So there is some sector risk with this ETF. Market cap is, it's going to be large cap, and again, if you want to get technical, it's actually mega. So large cap, mega cap, and it's going to be actually large cap value, meaning most of the companies in XLV are going to be slanted a little bit towards value companies versus growth companies. So whereas, we did previously, VTI was a large cap blend somewhere in the middle. This one is, XLV is not in the middle. It is more leaning towards the left or large cap value. So most of these are not really growth stocks. Okay. Yeah. So quick review, ticker symbol XLV. Expense ratio 0.09 of 1%, still pretty cheap. Dividend is 1.6%, which is decent. 10-year return is about 11%. So I believe that's a little bit less than VTI. So with anything in the defensive sector, XLV is one of them in healthcare. There should be, theoretically, on average, there should be less volatility, meaning that if there's a market crash, XLV will not crash as much as, say, S&P 500 fund or a total stock market fund. And sometimes there might even be a little bit of a negative correlation, meaning that during a market crash, if VTI goes down, XLV may either go down a little bit, or it might actually stay positive. It might be up a little bit, meaning that XLV might go up, VTI may go down. So it may have a little bit of a negative correlation to VTI or the total stock market because it's in a defensive sector. Sorry, got off on a tangent there. Dividend 1.6%, 10-year return about 11%. The index, it is healthcare ETF, so all the companies in XLV are healthcare related, and the majority, 90+%, are domestic companies, US companies. 62 different stocks or companies, 62 holdings, and it is a large cap value ETF. Okay, thanks for listening, guys, and I'll try to maybe do another video next week. Thanks.